Okay. Still got a couple people joining, but I think we'll go ahead and get started. Welcome. My name is Max Berger. I'm a senior wealth advisor here at Diversified, and I'm here alongside Ed Lynch to present this webinar on the new tax bill. A couple housekeeping items to go through. We are going to send out a recording of the webinar via email over the next couple of days. If you needed to leave early or you wanted to share this content with somebody else. Additionally, you can see that in the bottom right-hand corner of your screen, we do have a Q&A box. If you have a question that you'd like to ask Ed, we will have some time at the end of the presentation for questions, so please put them in the chat. If you have a personal tax question, please direct that to one of your advisors or the tax team. And if you have a question that we're not able to address with our allotted time, we'll make sure that we note down your name and get back to you following the presentation. If you weren't already aware, we do have an integrated tax company here at Diversified called Diversified Tax. And if you're a current wealth client and you're interested in the tax services, please reach out to your advisor. And if you're not a wealth client and interested in our services, please put your name in the Q&A and we'll make sure that we reach out to you after the webinar. Without further ado, I'd like to introduce Ed Lynch. He is the Vice President of Tax Services at Diversified, and he has over 3 decades of experience in the tax field. He's worked for private companies on the healthcare and the sports side. He's worked for regional CPA firms in both Delaware and Pennsylvania. And in 2001, he opened up his own tax firm where he focused on tax planning, tax preparation, and consulting for individuals, businesses, and not-for-profits. Ed is responsible for integration of tax and financial planning at Diversified. He has a business degree from the University of Richmond, his Master of Taxation from Villanova University, and has his CPA licenses in Delaware and Pennsylvania. In Ed's spare time, he is active in his community. He sits on various not-for-profit boards and is also a soccer referee and coach. So without further ado, I will turn it over to Ed as he's going to do most of the talking and expertise for today.
Thanks, Max. Good afternoon, everyone. Hope everybody's having a great summer. Today, we're going to talk about the new Tax Act that was signed into law back in July. It's going to be sort of at a high level because there are some very detailed changes that will take more than 45 minutes to go over. So at a high level, we're going to go over the major changes. We're starting, and just as an FYI, the IRS is still providing guidance on a lot of the tax changes and the new tax provisions. So don't be surprised if some of my answers to your questions or questions in general will change over the next couple months as the IRS issues new regulations and quantifies things. Also hearing that because of the tax changes, the start of the filing season could potentially be more like mid-February instead of usually around the 3rd or 4th week in January. You can start to e-file your tax returns, but now they're talking about potentially mid-February starting the filing season. They haven't talked about extending tax season. Hopefully they don't do that, but just as a FYI. Some of the things that we're going to talk about today are the key tax changes, what that means for you, planning opportunities, and then we will we'll jump into some questions and answers. So basically, as we chatted about earlier, early July 14th, or sorry, July 4th, the bill was signed into law. The tax changes affect both individuals, families, and businesses. There are some new deductions and credits that some will start in 25, some will start in 2026 and go through 2028. Also, there's some new, potential planning opportunities from a tax planning point of view. And part of what the Tax Act does is it makes many of the changes that occurred in 2017 permanent. Some examples are there's no itemized deduction phase out, which before 2018, if you made a certain amount of money, adjusted gross income was a certain amount, your itemized deductions started to become limited. They also made permanent, there's no personal exemptions, so they're gone. Mortgage interest deduction is limitation is made permanent. And basically what that means is if your mortgage or mortgages on your primary and your second home, if one exists, are over 750,000, your mortgage interest deduction starts to be limited. Miscellaneous deductions are gone. What generally was in that category was moving expenses, investment fee, a deduction, and some other deductions that had a 2% floor based on your income. That is no longer, or that continues to be no longer, and was made permanent. And also for businesses, the qualified business deduction was made permanent. And so as we talked about, that the 2017 tax cuts were made permanent pretty much for the next couple of years. The tax brackets will stay the same. They'll be indexed for inflation, and also the standard deductions remain in place, subject to being changed for inflation. And there are the current 2025 tax brackets per the new act. Some standard changes. They as we talked about earlier, they kept the standard deduction relatively the same. Increased a little bit for inflation. They did increase the child tax credit from 2,000 to 2,200 per child. That is for children who are under 17. And there's also income limitations on that. So at a certain income level, you start to lose that child tax credit. They also come up with a new investment account for kids who were born between 2025 and 2028. And this is not a tax deduction. It's not a tax credit. It's just an investment tool for newborns. So basically, what's going to happen is and this all starts in 2026, but it applies to kids who were born in 2025. So sometime in 2026, the IRS and the U.S. Treasury will start opening up these accounts for kids born in 2025 who have Social Security numbers. Very important about the Social Security numbers. And the IRS and the U.S. government will put $1,000 into that account. And then parents and relatives and other individuals can put up to $5,000 each into this account for a child. That starts in 2026. Again, that's not a tax deduction or tax credit. It's just investing for newborns. I believe the kids can start to take money out of that account when they hit 18, and the growth in that account is not taxable. There's a couple couple items that will affect many of our clients is there is now a deduction, and for the tip income and the overtime income and the senior deduction, which we'll talk about in a minute, these are additional deductions over and above the standard deduction or the itemized deduction, if that's better for you. So basically, on tip income, if you make, you can basically deduct up to $25,000 of your tip income. There's some more detailed rules that you have to follow. And there are, and same with the overtime pay. So basically, if you qualify the up to 25,000 of your overtime pay, will act as a deduction. There are some phase outs. So basically, actually on the tip income, the phase outs start at, for single head of household and marrying filing separate, at 150,000. So once your adjusted gross income is 150,000, it starts to get phased out, and I believe it phases out fairly quickly. That's one of the things that they really haven't fine tuned yet in the regulations. Married filing joint, the phase out is at $300,000. Overtime is for a single person, it's up, single person head of household, married filing separate, it's up to $12,500 of overtime pay. Overtime pay can act as can be deducted from your adjusted gross income. Married filing joint, it's up to $25,000. Again, that has a phase out of $150,000 adjusted gross income for single head of household, married filing separate, and $300,000 for married filing joint. Car loan interest. For some of you who have been around a while, you might remember when you could deduct your car interest on your Schedule A. Well, that's now back. Now there's certain rules that you have to follow. One is it's effective for 2025, and it's up to $10,000, and the car needs to be under $14,000 gross vehicle weight, and the final assembly has to be in the US. There's also, of course, phase outs on your adjusted gross income. $100,000 phase out if your filing status is single head of household or married filing separate. $200,000 for married filing joint. Senior deduction. So we've had quite a few questions on this, as back during the late last year, during the elections, there was talk about making Social Security not taxable. That did not happen. Social Security is still taxable up to 85%, depending on your income level. That hasn't changed. But what they have added is what they call a senior deduction. So if you're 65 and over, you can deduct up to $6,000 against your income. There are some phase outs If you are single head of household, marrying, filing separate, it's 75,000, and it's 100,000. Sorry, 150,000 if you're married filing joint. So that is for people who are over 65 and over, and that deduction is in addition to standard deduction and the other deductions that we spoke about. Charitable deduction. So this is a 2026 change. So for 2025, the rules are the same. If you itemize, you can take you can claim charitable deductions to qualified organizations. In 2026, there's actually two changes to the charitable deductions. One is if you do not itemize and you take this standard deduction, the IRS will allow up to $1,000 for single head of household, married filing separate, and $2,000 for married filing joint. They'll allow up to those amounts as an additional deduction over and above the standard deduction. This occurred back in 2020, 2021 during the COVID period. So those are much smaller amounts. So they have increased the amounts significantly since then. So that's a 2026. Also for 2026, if you do itemize, there's now a floor on your total charitable giving. And what I mean by that is basically you take your adjusted gross income, multiply it by 0.5%, and that's your charitable floor. So your total charitable giving over that floor will be a tax deduction if you itemize. It's similar to the medical floor, which is 7.5%. Same type of calculations. So just be aware for some of our higher earning clients, higher income clients that do significant giving, that there is a floor in 2026. Estate and gift tax planning, we'll just chat about these real quick. The estate exemption is raised to 15 million per person, 30 million married filing joint. They made some changes to trusts and gifts and legacies strategies, and there's no immediate sunset on the estate exemption. If you have not done so recently or in recent years, I do suggest that you look at your estate planning and make sure that it's up to date for your current family structure and your wishes going forward. SALT deduction. So one thing that changed back in 2017 was they capped state, local, and real estate taxes at $10,000, which made a lot of our clients go from itemizing to be standard deduction. And there's been some workarounds through businesses throughout the years, and those workarounds still may be applicable even with this change. And so basically, with the SALT change, it basically raises your state and local income tax withholdings, and your real estate taxes, your personal property taxes have raised that cap from 10,000 to 40,000. There is a phase out at 500,000 of adjusted gross income. It'll never get phased out below the $10,000. So you won't be hurting yourself from a itemizing point of view, if your income is high enough that that you're subject to the phase out. They also, I think we talked about earlier, they eliminated permanently the non-military moving costs or moving expenses, the miscellaneous deductions, and the green energy tax credits, which we'll talk about in a second. A couple things that just to chat real quick about is the speaking of the green energy tax credit. So basically, at the end of 2025 or at the beginning of 2026, the tax credit for energy efficient home improvements like new roofs, doors, windows, HVAC systems, heat pumps, that goes away after 2025. So if you're planning to doing any home renovations, want to potentially purchase this type of equipment improvements that will qualify, you need to do it in 2025. Same with the residential clean energy, which for most of our clients is solar energy. That also ends after 2025, and that can be 30% credit off the cost of the solar panel system. So both of those credits are gone after 2025. Clean vehicle credits, they are gone either on used vehicles or new vehicles. They are gone after September 30th. So of this year. So September 30th, 2025 is the last day for this particular tax credit. If you have purchased a vehicle but have not, and you don't receive it because of the timing of shipment or production delays, but you've purchased the vehicle before September 30th, it will qualify for the credit. But as you get closer to September 30th, you definitely want to verify that you qualify for that credit. If you go into the car dealership on October 1st and say, I want a energy efficient vehicle, there is no credit left for that. And for businesses, not that we don't want to forget about businesses, they have reestablished for 2025 the 100% bonus depreciation for your business fixed assets. So basically, and it was going to be like 40% in 2025, is now 100%. So basically, any type of fixed asset, new or used, will qualify for the bonus deduction. Even if the business has a loss, you can still take the bonus deduction. They also increased Section 179 a deduction up to 2.5 million of fixed assets. However, with Section 179, you cannot create a business loss with a Section 179, which makes the 100% bonus a depreciation even better deal. And then you also for 2026, if your business issues Form 1099s to a non-employee compensation, that floor goes from $600 to $2,000. So that's effective for 2026. Um, there's with all these changes, there's a potential for changes in your own tax plans for 2025 or changes from what actually happened in 2024. We do offer tax planning services where if you're existing clients, we'll take your prior returns and we'll create a 25 tax plan for you. Come up with some or try to come up with some suggestions to lower your taxes, and but also see how this new tax act will affect your 2025 taxes, even if you don't have any new sources of income or deductions. Also, again, there's in the tax planning phases, there's short term, in from a tax planning point of view, with this new tax act, are you going to have more deductions? So, should you adjust your withholdings at work so that you don't create a really big refund come April 15th? Not that that's a bad thing, but you might be able to get more cash flow during the year. Also, more midterm, 25, 26. If you're planning on doing some sizable charitable giving, we can do some tax plans to see and tax scenarios to see what year is better to make the giving. Should you think about a donor advised fund, and it's all part of the tax planning services. And then long term, as we talked about earlier, estate planning, gifting, retirement drawdowns, strategies to reduce your IRA, your traditional IRA income, your 401ks, 403bs, your that could potentially affect your beneficiaries. And
Yeah, Ed, thank you. This is great, and really on that note, whether it's tax planning or planning on the wealth side here, where we're taking tax situation into account, we're here to help. Whether we're meaning on the wealth side, your advisor is working in concert with the tax team, or we're using one of the various tax or planning softwares that we use. All the softwares that we use are constantly being updated with changes and details such as that are in this bill. So please reach out anytime, whether it's to your advisor, the tax team, to get started. So with that, I think we're gonna open it up for questions, which it looks like we do have a couple here. I'm actually gonna address the first one, and then Ed, I'm gonna kick the other couple relevant ones to you. So we did get a question about the Trump savings accounts for newborns in regards to the amount of contribution and where those types of accounts can be opened. So it is a $5,000 annual contribution across all collective sources. So it's not parent, grandparent, friend can all do $5,000 into the account on behalf of the child. It's $5,000 collectively. And then the second part of that question is, where can you open up that account? Is it government controlled, or can you open one of those up at Diversified, for example? The answer to that question is the government is going to seed with that initial $1,000, but then you're going to be able to open up these types of accounts at any sort of accredited bank or brokerage institution like the ones that we use here. So ultimately, these custodians and banks are still getting around to the logistics behind being able to open up those types of accounts, but more to come on on that is the short answer, but you will be able to have some control over those types of accounts. And I have two questions here that are related to some of the tax credits, one of which is
Mhm.
for electric vehicles and one is for the green energy. So question number one is, does the vehicle credit only apply to electric vehicles, or do hybrid vehicles qualify as well?
It's my understanding that all vehicle credits go away as of October 1st. So there's no more vehicle credit, but I will double check that.
Okay, great. And then the second one is with the green energy tax credits, is that on items purchased or the installation of the items?
Should be installed by the end of the year.
Okay, great. We had another question in regards to when you say changes for 2026, does that mean tax year 2026 to be filed in 2027? Or if something is happening for 2026 that was based on a new law that went into effect in 2025?
So when I mentioned 2026 and like this, then the charitable deductions, that means for the 2026 tax year, which you would file in April of 2027. For a lot of the changes where it takes effect in 2025, it's for this particular tax year for tax returns that are due April of 2026.
Perfect. We have another question here. Is the backdoor Roth still in play? Yes, there wasn't anything preventing that from happening. So that's still a planning opportunity going forward that we certainly utilize based on your situation. And we have another question here with regards to the vehicles. Does the vehicle interest tax credit apply to only new vehicles? Or can it be a used vehicle?
I believe it's on new vehicles that final assembly is in the US.
Okay, great. Just looking over a couple other questions. The tax credit ceiling for an electric or hybrid new vehicle purchase must be made before the 1st of October. What's the tax credit ceiling for that based on somebody's income?
So I don't have the income phase out um, handy, but basically the amount of credit and the credit phase outs are the same as they were in 2024. So they're not possibly adjusted a little bit for inflation for this year. Um, but as far as I know, there's no the amount of the credit calculation and the credit ceiling are have not changed.
Perfect. And the last question we'll take here, and we really appreciate everybody's attendance and time, is about 529s versus the accounts for newborns. And ultimately, it's pretty early on in this process and understanding the benefits of the Trump savings accounts versus 529s. At a high level, there's more flexibility for use of funds from the new Trump newborn accounts versus 529s, which are specifically for qualified education. But the trade-off is that the child is going to have more access to those funds, whereas the 529s are a lot of times controlled by the parent, grandparent themselves. So more planning conversations and opportunities around those to come. But again, Ed, fantastic job.
Thank you.
Very, very informative. And thank you, everybody, for attending. We really appreciate you and hope you have a great rest of your day and rest of the summer. Take care.
Thanks, everybody.